a research and development tax credit, a low-income housing tax credit.
On principle, no one in America should have to pay more than a third of their income.
I want to cut taxes for 95% of all workers.
Hello, Internal Revenue.
Yes, I was trying to find out how many pages the tax code is.
Oh my God, I have no idea.
Discussion of taxes is fiddling with technicalities and missing the point.
There's not an American breathing today that's not affected by the tax code.
In the last 20 years, I think we've amended the thing 14,000 times, added 3 million new words.
It is so complicated, you have no idea whether or not you've done it right or not.
Because, you know, the way you tax, a lot of people argue, really defines what you are as a country.
Virtually no one in the Congress has a sufficient grasp of the code.
So our income tax system is extremely complicated, and it is very important to understand your income taxes. That's why we're going to give you an overview of personal income taxes.
I'm Kevin Roach. I am an executive professor here at Texas A&M, and the subjects I teach are tax, both undergraduate and graduate. Personal income tax, first of all, it's important to note that the United States is one of the few countries in the world that has a self-assessment system, meaning all Americans are obligated to voluntarily submit their information about whether or not they owe taxes, and they are obligated to calculate how much tax they owe. In our system here, we have a division of the government, part of the Treasury Department, the Internal Revenue Service, the IRS. Their job is to make sure that our Americans are adequately and accurately fulfilling their obligation to submit their tax information appropriately. So that system then means that an individual basically says, how much income do you have? And offsetting that income are certain deductions. That computes your taxable income. We have a system also then that subjects that tax to a tax rate, and that rate can depend on whether you're single, whether you're married, and these rates are what we call graduated rates. We have a system here in the U.S. that is called a progressive tax system, where the rate of tax goes up the more income you make, so that lower income taxpayers pay a much lower rate, begins at 10%, and it can go as high as 35% on those taxpayers who have much higher levels of taxable income.
So that is a brief overview of personal income taxes. Now you might be wondering, who must file their personal income taxes? To determine who must file their income taxes, we must first look at the filing statuses. Here are the 5 different filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widower with a dependent. If filing as single and under the age of 65, you must file a return if your income is at least $9,500. If over the age of 65, the income requirement is $10,950. If married filing jointly and you and your spouse are under the age of 65, you must file a return if your income is at least $19,000. If one member of the married couple is over the age of 65, the requirement is $20,150. If both spouses are over the age of 65, the requirement is $21,300. Now, if you're married filing separately, you must file a return if your income is at least $3,700. Filing head of household and under the age of 65, you'll have to file if your income exceeds $12,200, and if over the age of 65, $13,650. And finally, if you are a qualifying widower with a dependent child under 65, you must file if your income is $15,300 or over 65, $16,450. Claiming a dependent. The purpose of claiming a dependent, like a qualifying child, is to take advantage of a number of tax benefits. Taxpayers who claim dependents can claim an additional personal exemption from each dependent. Also, taxpayers may be eligible to claim the child tax credit, the child and dependent care tax credit, and the earned income tax credit. A dependent can only be awarded one taxpayer unless a couple is filing jointly. What is the difference between standardized deductions and itemized deductions?
As we get into, again, going back to, we have income and then we have deductions. First of all, there are two categories of deductions. There are deductions that everyone gets regardless of whether they itemize or not, and those are deductions in reaching their net gross income. We call them deductions for or above the line, and the line being adjusted gross income. Some of those are, let's say you pay alimony. That is deductible for everyone, and that is not an itemized deduction. Another one is if you're in a business and you have business expenses. Those are deductible for everyone in reaching gross income. Once we hit gross income, here is where individuals have to decide. It's up to them. Do they want to have a standard deduction that will further reduce gross income, or do they want to claim itemized deductions? And the decision is really, do you have sufficient itemized deductions such that they're greater than the standard deduction? The standard deduction, for example, in 2011 is $5,800 for an individual. It's $11,600 for a married couple. So if you are a single individual and you don't have eligible itemized deductions of at least $5,800, you're going to claim $5,800 as a reduction of your gross income in computing your tax. Now, what are these itemized deductions, you ask? Well, the categories are medical deductions, state tax deductions, charitable contribution deductions, interest deductions, casualty losses, explain that in a second, and then there are unreimbursed employee business deductions and investment expenses. If we look at those, the most common for American taxpayers are, if you're in a state or you own a home, you're going to have property taxes. Those are deductible. You're going to have interest on a mortgage. That is deductible. If you're generous in giving to charitable organizations, those are deductions. If you're sick and have unreimbursed medical expenses, those are deductions. If you, for example, have a fire that burns your house down and you suffer an economic loss, that is a deduction. Now, certain of these deductions have limitations associated with them. It's not, can I claim every dollar of medical expense that I didn't get reimbursed by insurance? And here's where these limitations come in. These limitations are either what we call floors or they're ceilings. A floor limitation says that you can only deduct these otherwise deductible expenditures if they are of an amount that is greater than a percentage of your gross income. For charitable contributions, this is an example of a itemized deduction that has a ceiling limitation. For those that are particularly generous, what that means is they can't deduct more than 50% generally of their gross income in a particular year. The good news about a ceiling deduction, as it relates to charity, if you can't deduct the full amount this year, you gave more than 50%, that excess you can use in succeeding tax years. So as we look at itemized deductions, we first have to say, do we have enough after considering these floors and ceilings such that it's greater than the standard deduction? If so, I'll claim the itemized deduction. If not, I'll claim the standard deduction.
Awesome. Well, a bunch of people say they're going to write off their taxes. So what does it mean to write off your taxes?
Okay. write off their taxes literally would mean that they're going to write off taxes they paid as a deduction. I believe what most people mean by that is that somehow or another, that if they incur something that is deductible, that they can write it off as a deduction. In essence, the cost of that expenditure has been reduced by the tax benefit they're going to receive from that deduction. And here is where we get into, it's either more benefit or less depending upon what tax rate you're subjected to. Let's say, for example, someone has a deduction, let's say a valid charitable contribution deduction of $100. And we have somebody else who also has that $100 charitable contribution expenditure. Both of them can write it off or claim a deduction, but the net benefit, if the first person is in a 35% tax bracket, they'll get 35% or $35 of reduced taxes. Someone who, in the other hand, is only in a 10% bracket will only get $10 of benefit for the same deduction. So when we talk about I'm going to write it off, I think you're referring to the fact it's deductible. How much you get for that write-off depends on your tax bracket.
Self-employed tax obligations. The IRS defines self-employed as you carry on a trade or business as a sole proprietor or independent contractor. You are a member of a partnership that carries on a trade or business. You are otherwise in business for yourself, including part-time business. If you are a self-employed individual, you are required to file an annual return and pay estimated quarterly taxes. You have to pay a self-employment tax, which is primarily a Social Security and Medicare tax, as well as income tax. In order to determine if you're subject to self-employment tax and income tax, you must figure your net profit or loss from your business. To do this, subtract your business expenses from your business income. If your expenses are less than your income, the difference is net profit and becomes part of your income. If expenses are more than income, the difference is net loss, which you can usually deduct from your gross income. You must file an income tax return if your earnings from self-employment were greater than $400. Tax returns of small business owners versus wage employees. Generally, as a small business owner, you must withhold federal income tax from employees' wages. You withhold part of Social Security and Medicare taxes from your employees' wages, and you pay a matching amount yourself. Therefore, small business owners' taxes end up being quite a bit more than the taxes of an employee earning a wage. To file annual tax returns, small business owners must use Schedule C to report income or loss.
My name is Trey Martin, and I'm Mug Walls Java Bar here in College Station, Texas.
What we want to know, I think, as like in our class is like, because we're all wanting to be entrepreneurs, so we're wanting to know like, is it the best way just to get a CPA and let them deal with it, and then
It's interesting because I was just talking with one of my employees the other day who had a question about their returns, and I said, well, just ask your CPA, and then my manager pointed out she's a college student, she didn't have a CPA, but it really is. I mean, he's a small firm. I can ask him simple little questions. He's not billing me by the hour. He gets my business in bulk and knows what I'm going to need, and especially in setting up businesses. And if you're an entrepreneur and you're going to set up a business, get you a good. And my lawyer is a phenomenal, high character guy. He's actually a home church pastor back in Houston. I know him quite well and his family, and my accountant and my lawyer know each other, and so those are your two best friends if you're setting up a business, just from a standpoint of the state and taxation, as well as getting all the paperwork done to making sure your liabilities are covered. So you want to find, you need a lawyer and an accountant. You want them to know your operation, you want them to know you well, and stick with them in the long run. I would not do them myself. You can do QuickBooks, and there's a lot. It also depends on the industry you're in. Because I've been in other industries where I could use QuickBooks, and if you're just in like individual retail where you're producing a product at home and selling it, you can just use QuickBooks. I have a friend who does that. She's an artist and she produces a product and sells it. Do that. For me, I have a point of sale system, so it keeps all the taxes and everything, thousands of transactions a month. I can print off reports and do it. So at that point, I can just give the accountant reports and receipts, and it is cost effective. But if you were to not have any of that information organized, then you're going to need either QuickBooks or a point of sale or something like that. But it's one of those things you don't want to slip up on, so it's worth spending the money now to save the money later.
Mm-hmm. Most hectic thing when dealing with taxes?
3 words: IRS. Just the tax code. I mean, there's so many things, you know. Mm-hmm. Really, I think like I just said, it all comes down to organization. So if you have all your information organized and you get it to your accountant, it's pretty simple at that point. Mm-hmm. And so my point of sale system is great. If somebody, you know, if I get audited or anything like that, I can just pull up reports off of the computer and do it from there. It just depends on the kind of operation you're doing. If you're doing service industry where you're a consultant, you know, you're just going to need to keep meticulous notes, and they have systems where you can, like, you know, scan in all your receipts and everything and code them there, and that's really in the past, you know, couple of years that's become very prevalent. And so even if you're just working by yourself for yourself, get some sort of program where you can scan everything and keep all the information organized.
Mm-hmm. And what's the difference, like, whenever you were just filing your regular taxes before you own your own business? What is the difference between your business filing as a business taxes and your personal income, and then whenever you weren't doing that?
He takes care of most of it, but a lot of it is in receipts from personal things. So I do a lot of business research and development and things like that. And whereas it could go under personal, if I use some of that information, I can put it under business. So he takes care of most of that. I don't keep up with it a whole lot, but I get him receipts and let him know what I was doing and what's going on, allow him to file that.
Mm-hmm. Cool. Do you know any deductions that you use, or any tax benefits that you can write off with, or do you just let him?
I mainly let him do it, and I just tell him, and he's very trustworthy. It's funny because I don't want to abuse the system as far as, you know, trying to. I was actually having a conversation the other day with somebody, and they said, if I go out to eat and I even, you know, speak the word of the industry I'm in, then I just write it off, and I'm not really into doing that. But I do go out, and, you know, especially I'm planning on going to Europe, and a lot of it is just going to be kind of see what the market is, looking into doing some Turkish coffee. And so if I go to Turkey and I'm researching that, you know, some of those expenses I'll definitely write off, and some of them I won't. If it was just me, you know, I don't want to go to the Acropolis and write it off that I was researching something for my business. Yeah.